All right, let's proceed with S19, employee benefits. Now here they're speaking of defined benefit plan amendments. Maybe you have amended the plan. You have made a curtailment, as I told you, this related to past service cost, or maybe you have made the settlement, right? You have made the settlement. Maybe you have transferred employees have transferred to another company, and so you have also transferred those obligations, but in exchange for a particular consideration. Okay, what's the problem now? What we're just trying to take a look here. If there is a plan amendment, settlement or curtailment, PAC, or this is just an abbreviation, right? P for plan, A for amendment, S for settlement, and C for curtailment. If there is such a thing, either of them, either plan amendment, settlement, or curtailment, then the effect of this is calculated by comparing the net defined benefit deficit before and after the event. You can just compare them, right? What was the difference before and after, and arrive at the result. But even though the reporting entity remeasures the defined benefit deficit in the event of this situation, maybe you have amended something and you have compared the defined benefit deficit, right? IAS 19 did not previously require the use of the updated assumption to determine the current service cost and net interest for the remaining period after this one. Initially, it did not require that. And so the board argued that ignoring those assumptions is inappropriate because these are likely to provide the most faithful presentation of the economic impact. And as you know, as per conceptual framework, faithful representation alongside relevance are the points which make information useful, right, to users of the financial statements. Fundamental characteristics of financial information should be faithful representation as well as relevance. And as you know, faithful representation encompasses things like prudence, encompasses things like neutrality, things like being free from error, such things, right? Okay. And so, if you're told here that in that case, we have to take a look at the following amendments now. Amendments. So the board amended S19 to clarify that the reporting entity must determine the following so as to account for that. First, the current service cost for the remainder of the reporting period after PAC, using the actual assumptions used to measure the net defined benefit liability. Let's say that the year ends at 31st December, but maybe either a plan amendment, settlement, or curtailment has occurred maybe in April. So in that case, you as an entity will have to determine again the current service cost for the remainder of the reporting period. If it's 8 months, you have to determine that, right? That's number one, because things would have changed. If you do that, even the liabilities would have changed. And in that case, you have to reassess everything. But also, you have to reassess the net interest for the remainder of the reporting period after the PAC using the remeasured defined benefit deficit and the discount rate used to remeasure the defined benefit deficit. Do you know why all these questions are asked? Let me just tell you one thing. It's nothing much. When speaking of the defined obligation, the liability, it is usually computed as a present value. And as you know, from the concept of time value of money, when the figures are just related using the concept of time value of money, present value, if you compute the present value, you obtain a certain future value. So in case you change something, you really need to revise everything, right? So that's why you're speaking of the net interest, because net interest is usually a given percentage, that is the discount rate and the net of the planned assets and liabilities. So since we're just changing those service costs, you are changing the liabilities, and also you have to change the net assets, right? Okay, so let's take a look at this simple example and then finalize. So the question is here, McVeigh, which has a year end of 31st May 2023, has a defined benefit pension plan, Plan A for long-standing employees, no issue. The net deficit recognized at 1st June 2022 was, which I think should be the beginning of the year, right? Because if the year ends at 1st May 2023, and this is 1st June 2022, then the net deficit recognized was 1.5 million, and the interest rate on the good quality corporate bonds at this date was 4%. All right, no issue. Then a net interest component of 5 million, which was obtained as a discount rate as usual, times the net obligation or net asset times 125, which was 5 million, has been charged to profit or loss. No problem. The current service cost for the year was calculated using assumptions as at 1st June 2022, which is just normal, and expensed to profit or loss as part of the service cost component. Now, do you see? There still was no any amendment or any curtailment, right? Or any settlement. And this is what has been computed. But let's say in months forward, either curtailment or amendment or settlement occurs. What would you do? Here, the point is here. On 1st March 2023, that was 2 months later, right? Members of Plan A were offered a settlement. Now, do you see this? Sometimes you have to read the question, no, oh, so this question involves that thing. A settlement was made. What was the arrangement? If you settle something, actually, you pay something, but also you extinguish a liability. All right. So we are told here that a loss on settlement of 3 million was calculated. Actually, they have not specified the obligation that went away, but also what we paid. All we know is that there was a loss on settlement. That means we paid far more than what we are owing, right? So there was a loss on settlement of 3 million was calculated and accounted for as part of the service cost component. This is something we usually do, no issue. If there is an issue on the settlement, I told you, amendment, settlement, curtailment, just for as part of the service cost component. This was determined by measuring the deficit on 1st March 2083, both before and after the settlement, using updated assumptions. On 1st March 2023, interest rates on good quality corporate bonds had fallen to how much? To 3% as at that date. So actually, for the remaining months, actually the interest had changed. So it's like you are just trying to restart something. Okay, the remeasurement loss has been calculated and is being released to other comprehensive income, which is usually the case, or the average remaining working life of the settlement scheme members. Okay, the loss is presented as an item that might be reclassified to profit or loss in the future. Now required, advise the directors of McVeigh as to why the current accounting treatment of Plan A is incorrect. Why is that situation incorrect? This is test understanding number 7, right? Okay, let's go there to number 7, test understanding number 7. Yeah. Okay, so these are the explanations we should go through. So first of all, you have to follow those procedures, right? As we say, in case there is a plan amendment, settlement, or curtailment, you have to follow those procedures, right? On the net interest component as well as that remaining current amount. The calculation of the past service cost or a gain or loss on settlement. As I told you, when you speak of past service cost, you speak of amendment or curtailment. But also, if you have something on settlement, you also have to include it, right? So the calculation of the past service cost or gain or loss on settlement or curtailment requires the recalculation of the defined benefit deficit, but also net interest, as we say. So these updated assumptions should be used when calculating the net interest component and the current service cost for the remainder of the reporting part, for the remainder of the reporting period. Okay, the settlement now happened after 9 months, right? After 9 months, because is it really 9 months? The settlement happened after 9 months. Didn't they say first March? Let's go back to the question. See, the question is number 7. So test understanding number 7. The question was here. All right, the year was ending 31st May, 31st May 23. The year was starting 1st June 23. It's 2. It was ending 31st May 23. When did the plan change? Okay, the plan changed on the 1st March 23. So 1st March 23 to 1st May 23, whole of March, whole of April, and all of May. Right? Yeah, this is 23. I thought it was 22. 23. So only 3 months have remained to the year end. So actually, it was this change, this settlement occurred 9 months later, right? Yeah, that's fine. So let's go back to the question here. And that's why you say that the settlement happened after 9 months. So we agree with this, right? The net interest component for the first 9 months of the year should therefore be based on the 125 broad fat. No issue, because and for 9 complete months there was no issue, there was no change. So there should be no problem at all, right? So that's why you say it should be based on 125 broad fat deficit and the interest rate of 4% at the beginning. So that's no problem at all. So to obtain that net interest component, as usual, we take the balance at the beginning, we multiply by that interest rate at that beginning, and then you apportion it by 9 months before the change of the plan, before the change, the settlement, right? And we obtain that figure. We remain with 3 months to account for now, right? But we are told that just after that tournament, just after that settlement, this rate changed from 4 to 3. So, however, the net interest component for the final 3 months should be based on the recalculated deficit and the interest rate on that date, right? So it was 3%, right? So you really need to base on that amount, 3%, but also not 3% times 125. No, it should be based on the new value of the obligation, right? Yes. And so what about the current service cost? The current service cost has been calculated using assumptions at the start of the year, but actually it has to change, right? However, the current service cost of the final 3 months of the year should have been determined using the assumptions used when remeasuring the deficit cost settlement. Yes, this is usual. Because, you know, the current service cost, but as for CCA, for example, not just for CCA, for a lot of academic platforms, actually, they usually do not explain how uh, current service cost is related to the present value of obligations. But actually, there is a way. There is a way that you determine that salary for the last year. You just make more computations and you determine those obligations. But usually they avoid that because it involves computations of time value of money and such, and so they usually avoid that. But one day maybe we'll just try to do that to get much more reality. Okay. Choice 19 does not allow the remeasurement component to be deferred. Instead, it must be recognized immediately in other comprehensive income. You should never defer this remeasurement component. Actually, you have never seen that, right? So just take it to other comprehensive income. And McVeigh has also misclassified the loss. The remeasurement component is an item that will not be reclassified. Yes. You know, there are components that can be reclassified to profit or loss from other comprehensive income and other that should not be. The question said that it was made that it could be reclassified to profit or loss, right? So these were just explanations, and I'll have to find a certain day where we can just maybe try to determine this service cost, because so far we have been being given that service cost amount, right? But really sometimes maybe you can be hard to compute that, but I've never seen that in exams. But that's how it really works. Okay, I think for computations we are done. Asset sailing, we spoke about this, made it in that previous lecture. We did all of this. This is just another example. For example, you are given everything already, current service cost, benefits paid. No, nothing much. Okay, maybe let's just go to other issues now. We spoke of 4 employee benefits. So for post-employment benefits, we are done with that, right? Okay, we can also have short-term employee benefits. There is usually nothing with these. This one, you can just do them directly. Just find the question, just do the distributions and everything becomes boom. For example, short-term employee benefits, you could have wages, salaries, maybe bonuses and other benefits. You know, there can also be benefits in kind, if you know that. So the general principle is that wages and salaries are expensed, right? It is expense, so they're expensed to profit or loss, as usual. On a normal accrual basis, you have incurred something, it is taken to profit or loss. If you have not paid something like that, you just say you have an accrued expense, just like that. Unless capitalization is permitted in accordance with another reporting standard. Yes, in case maybe there is a particular standard requiring you to do that, then you have to capitalize. But usually they are just expense to profit or loss. Bonuses and other short-term payments are recognized using normal criteria of establishing an obligation based upon past events, which can be reliably measured. It's just an issue of provision, right? Just like normal provision. Bonus, I expect to make this bonus. Let's make a provision if by 37, something like that. So it's not much. Maybe you can have compensated absences. You know, there are absences, maybe you cannot be present, but you can be compensated, but there are others that you will not be compensated, right? So this covers issues such as, let's say you have a holiday pay, you are at holiday, you have to be compensated. You are sick, maybe you have to be compensated. You are maybe the wife is at maternity, needs compensation, jury service, maybe study leave, just things like that. And the key issue is whether the absences are regarded as being accumulating or non-accumulating, right? You know, there are things which even maybe if you did not take them in time, it will cost you. You won't have to blame anyone and say that, oh, I have to get this. If they are non-accumulating, it will just be actually to your own destiny. So you could have accumulating benefits and non-accumulating benefits. Accumulating and non-accumulating. I think the explanations are just clear. The way they are just clear. Something accumulating. These are earned over time and they are capable of being carried forward. Let's say 1 year has passed and maybe you go to the second year, you can just carry it forward, but there are others that expire, right? So just speaking of expiry here. In this situation, the expense for future compensated absences is recognized over the period services are provided by the employee. And this will typically result in the recognition of a liability at the reporting date for the expected cost of the accumulated benefit and but not yet claimed by an employee. So that's the case. Even if an employee has not yet claimed, you can just be allowed to take that, right? Just take a look at this good example. An example of this would be a holiday pay accrual at the reporting date, where unused holiday entitlement can be carried forward and be claimed in the future period. So you can have something like this. So it could be accumulating or maybe it could be non-accumulating. But also you can have something like this, maybe it could be non-accumulating. And in this case, an expense should only be recognized when the absence occurs because it's non-accumulating. So only when an absence really occurs, it is when it should be included. While for accumulating, you just include that, and maybe you go to the second or financial position, you include something else, right? Okay. So that's why I say this may arise, for example, where an employee continues to receive their normal remuneration whilst being absent due to illness or other permitted reason. And a charge to profit or loss would be made only when the authorized absence occurs. But in case it doesn't occur, you cannot do that, right? So that's the difference between accumulating and non-accumulating. These are just different forms of these short-term employee benefits. Maybe you could have something called benefits in kind. I think I gave an example about benefits in kind. You know, for example, you may be a worker, you may be having house allowance, maybe having maybe say motor vehicle benefits, something like that. Maybe loan on the loan, maybe you may obtain subsidized loans, things like that. So we call these benefits in kind. They don't come in form of cash directly, but after they say maybe your children are taken to some schools and maybe you do not pay. The company pays for you. So recognition of cost should be based on the same principles as benefits payable in cash. Benefits in kind actually does not involve cash, right? So that's why they specify their benefits in cash. It should be measured based upon the cost to the employer of providing the benefit and recognized as it is earned. So do not say, oh, this is a benefit in kind. You cannot recognize it. No, no, no. You should just recognize it. If you do remember, even when studying taxation, on employee taxation, taxes for employees, you can find out that things like benefits in kind can be included, like motor vehicle benefits, loan benefits in kind, such things, right? Okay. The third category, basically studied with post-employment benefits that we did on defined benefits and contribution plans. Short-term benefits, right now you're on termination benefits, right? The third one, termination benefits. This also is very, very clear. The question is state. Termination benefits are what you might be entitled And so the benefits payable is a result of employment being terminated. Just depends. Maybe the employer has just decided to terminate an employee, or by the employee accepting voluntary redundancy. The employee himself, the employees themselves have accepted the redundancy. And such payments are normally in the form of a lump sum. Maybe we are giving you 20 million. Usually, they can say that, oh, let's give this guy the salary for 4 months, and then he has to go away. So they give you the lump sum so that you can go and proceed with your life while looking for other pastures. All right, so how do we do this? I think these are just obvious. You do not even need this one. Recognition is just a normal recognition. The reporting entity should recognize a liability and an expense in relation to termination benefits at the earlier of the date. When should you recognize this now? It's about termination. Has the termination actually occurred or what? So when the entity can no longer withdraw the termination benefits offer, on termination, it's just you just discuss, right? It's whether an employer has terminated or maybe you have to reach some consent. So when the entity can no longer withdraw the termination benefits, if you have no way, you just have to pay either that date or when the entity recognizes the restructuring cost in accordance with the 37, right? The cost of restructuring is when you just recognize the restructuring cost, it means that you have already seen that I'm just going to terminate these employees. Maybe I'm just going to close some division. So it's obvious that I'm going to terminate the employees. So if you do that, it's obvious that you would have had to include the termination benefits, right? You would have actually to consider this termination, right? Yes. So anything that occurs much earlier is when actually you should recognize a liability and an expense, whatever comes earlier, right? Just normal explanation, but this shouldn't bother you. It's like you're just doing other standards. And so an entity can no longer withdraw a termination benefits offer when a detailed plan has been communicated to affected employees. It's like they're just coming back to this I-37 because when speaking of the restructuring cost, restructuring is one of the examples of the provision, right? And there's for provision to say that you have restructuring, usually considered two parties on the company side, but also on the employee side. On the company side, there should be a formal and detailed plan about what is going to be done. Maybe like maybe the operations that are going to be stopped. But also you should have raised a valid expectation that this would happen. Maybe you have already started the restructuring. Maybe you have announced the plan to the employees, and so a valid expectation has been raised to actually the parties concerned. So that should be the case. And how do we measure now? Now that they're just trying to show you how to measure. You have said that, oh, I have to recognize the termination benefits. At what amount now? How do I measure that? So it's just a way of measuring, nothing much. Termination benefits are measured on initial recognition. This is not an explanation. This is obvious. Whenever you need to recognize something in the financial statements, you have to know its value. So initially, when you recognize something, it's obvious that you have to measure it on the initial, right? Because otherwise, you cannot recognize that. How do you recognize something for which you do not know its value? It's not possible. Okay, so we said that the reporting entity should measure and account for the subsequent changes in accordance with the nature of the benefit, as we see. Just depending on the nature of the benefit, maybe you would have to change that value, that figure. For example, if the benefit will be fully settled within 12 months of the reporting period, in which it is initially recognized, it will be accounted for as a short-term benefit. If it exceeds, let's say 12 months, it should be a long-term benefit, right? And so you have to know there whether it should be a current or non-current liability. And maybe if the benefit results in an enhancement to an employee's pension scheme, say that the benefit results in an enhancement of the employee's pension scheme, then the rules to pension scheme accounting are just applied. So it just depends on the situation the question comes. But usually, I don't know whether we'll encourage to find out something like this in an easy manner. Okay, maybe let's take a look at this example and then we would have the other long-term benefits which are just here and will be done. Okay, the question requires us to discuss the accounting treatment as usual of the plan. So let's just just read the question carefully and go to the Solution. Which has, though, a public limited entity plans to close a factory in 6 months, right? At that date, it will terminate the employment of all remaining factory employees. Now, that's why they just compare this thing with a 37 restructuring provision, because that you have that plan, it's kind of you need to restructure the company, right? Okay, so the factory has outstanding contract to fulfill and so announces a plan that will incentivize some staff to continue working. You see this, the factory has outstanding contract. They have to fulfill some contracts, so there are some staff that will have to remain. Each employee who works until the closure of the factory will receive a cash payment of 24,000. So they have to promise the employees on the termination date. Employees leaving before the closure date will receive only 8,000. So this is what is told to the employees. Then there are 100 employees at the factory. At the time of announcing the plan, now the entity expects 15 of them to leave before closure. So the entity expects 15 of them to leave before closure. So 15, I expect to leave before closure, while 85, I expect to leave after closure. So you can expect the amount that you have to pay, right? 15 before closure, you know the amount you have to settle. 85 after closure. So just go and apply that. It's nothing difficult. So it's number 9 here, termination benefits, right? So as we just saw it initially, when determining the termination benefits, you have to know the benefits in exchange for employee service. Okay, this company must pay 8,000 per employee, regardless of whether the employees render service until closure of the factory or leave before. Because we are told that there was 8,000, but also there was 20,000, right? 24,000, right? If you stay until that end, it's 24,000, but before it will leave before it's 8,000. So in either case, you must pay a minimum of 8,000. That's obvious, right? That's why we say that which heads must pay 8,000 per employee, regardless of whether the employees render service until closure, for which they will have to receive 24 or leave before it closes. Right? That's very fine. This amount is therefore a termination benefit because it's obvious that whether they proceed, whether you leave or you don't leave, we have to pay you that. So which also recognizes a liability of 800,000. That is 100 employees times 8,000 per employee for the termination benefits at the area of when the plan is announced and when it is recognized, the expected cost. Because we said that you have to take the area amount, right? Okay. Now, what are the benefits in exchange for employee service? There are some employees who maybe could remain until that date, right? And actually, we were given their numbers. We are told that 15 could leave before and how much? And then 85 could leave until after that date. So employees will receive an additional, how did they get this? Employees will receive an additional 16,000 because they are promised 24, but 8,000 is guaranteed. So they would receive an additional of 16,000 if they work on the full 6-month period, right? This is very, very right. And so the event creating the obligation to pay this amount is employee service. And so this is not a termination benefit because you will be paid if you work. It has totally nothing to do with the employment. So we are just trying to do the accounting treatment to separate how do we separate those items. They are both related to termination, but actually when the financial statement, you wouldn't call this a termination benefit. It's a kind of trying to convince employees to stay so as to fulfill the contract. And that's why we say that an expense now of this much amount should be included. Why should we include this? Because 15,000 is per person, but 15 of them we are going to leave before, and so only 85 would remain, right? Is that right? So they should be recognized. Maybe to recognize each month, you have to divide by 6 months, right? Because this one was for their 6-month period. So if you divide, you obtain this figure here. If you do divide, And this one should be recognized each month during the service period or 6 months with corresponding increase in the carrying amount of the liability. Something very, very nice. It's a very good example. I have actually liked it. Okay, so after this, I think we have about 7 minutes. Let's just finalize. Okay, after this, you have other long-term benefits. You can have other long-term benefits. Any benefits that are not there in those 3 categories above, not in post-employment benefits, short-term benefits, but also not in termination, should be other long employee benefits. So this comprises other items not within the above classifications and will include, let's say, long-term service leave, long-term disability benefits, and other long-term service benefits. So it's something like that, right? So just account to them in a similar manner. Just read the question and know how to proceed with that, right? So that's something you really need to understand. Just note this. If you have any remeasurement components here under these long-term benefits, you just have to take it to profit or loss. Do not deal with other comprehensive income as it is post-employment benefits for defined benefit obligation. All right, that's over. Disclosure requirements. These disclosures are usually what you do in the computation. For example, here, maybe you disclose significant actuarial assumptions. The actuaries do determine some values, like, for example, maybe the fair value of plan assets, present value of liabilities, actuarial assumptions used. Let's say, what inflation rate did they consider to obtain the final salary? Right, something like that. A general description of the type of plan operated, which plan you're operating, let's specify maybe it's a defined benefit, a defined contribution, a reconciliation of the assets and the liabilities, recognizing statement of financial position, reconciliation at the beginning and at the end of the year. We have done that, but we have done it in the form of net benefit, net asset or net liability, the charge to total comprehensive income, that remeasurement component, for example, right? You can just analyze everything. You can have that interest component. Just think like that. So these are the things that we have to take into account when dealing with such a scenario, right? Okay, so I think these are matters that you can just go through. For example, you are given things here. Maybe you have the defined benefit, sensitivity of the salary, things like this. Okay, so I hope actually everything is just fine. You can just go through this criticism maybe and see how you can proceed, right? For example, maybe people they get excited saying that, oh, this is very complex, as you have seen, a lot of components there. Maybe you can say that this can just be valued in the short term because actually there are some assumptions that need to be made. And so we say that S19 requires defined benefit plan assets to be valued at fair value. Fair value can also be very volatile and can be changing from time to time. So this one cannot be valued for a long time period, right? Think like that, right? Also about the concept of fair value volatility, I've spoken it here. Maybe how did you obtain that discount rate? It will be very difficult to obtain the relevant discount rate. So there are things that are still an issue here. Any question?